AI is a powerful tool.
This summit can help ensure that artificial intelligence charts a course that benefits humanity and bolsters our shared values.
Welcome to AI for Good, the leading action-oriented, global and inclusive United Nations platform on AI. Organized by ITU, in partnership with 40 UN sister organizations, and co-convened with Switzerland. The goal of AI for Good is to identify practical applications of AI to advance the United Nations Sustainable Development Goals and scale those solutions for global impact. In today's session, we're counting on you to use the live video wall feature to ask questions and post comments to help create an engaging discussion. We encourage you to stay until the end to chat, connect, ask questions, and network with our distinguished panelists and world-class AI experts in the neural network. It is now time to kick off the session and welcome our first speaker. The floor is yours.
Hello, everyone. I'm Rory McMillan, a partner at the law firm of McMillan Keck, very active in the digital sphere around the world. Well, I believe that we need to embrace the potential of AI. We're doing much that would ordinarily have been done by humans. And so in that spirit, I've outsourced my introductory remarks to ChatGPT. So here's what it produced when I put in AI and financial inclusion. Quote, artificial intelligence can play a significant role in promoting financial inclusion, especially in developing countries, where a large percentage of the population is unbanked or underbanked. Here are some ways in which AI can help. 1, traditional credit scoring models rely on credit history and income, which can exclude people without a credit history or formal employment. AI-based alternative credit scoring can leverage non-traditional data sources such as mobile phone usage and social media activity to assess creditworthiness. 2, AI-powered chatbots and virtual assistants can help people access banking services more easily and efficiently, especially in remote areas where there are no physical bank branches. These virtual assistants can provide personalized financial advice and support to people, answer questions, and help people make informed financial decisions. And 3, AI-based fraud detection systems can help prevent fraudulent transactions and protect consumers. AI algorithms can analyze large amounts of data and identify suspicious patterns, which can help banks and other financial institutions detect fraud early on. Unquote. Pretty good, huh? Well, but one thing that AI cannot do is come up with the individual personal insights and experiences of those right at the heart of the business. And that's why we're here. So take those with a vision for the direction that we should be going and the challenges we face along the way, like Arisha Salman, financial sector specialist with CGAP, who are doing hugely important work to figure out how to get financial services to work for those in poverty. Or AI can't invent the commercial business case opportunity and the innovations that the likes of Isaac Gachugu, financial services technical lead with Safaricom, one of the world's leading players in this field, is working on a daily basis. One of the biggest challenges I see as a lawyer advising governments and regulatory authorities around the world is the lack of understanding they often have and information they have about the markets that they regulate and the activities going on. Well, artificial intelligence cannot do what James Claude, CEO of Global Voice Group, who's with us here, can do, to explain to us how they use data to give regulators real intelligence, real-time data links, and actionable analytics to understand market trends, compliance by regulated companies, and make regulation much more effective. No AI could replace Alex Rizzi, Research Director at Center for Financial Inclusion, to help us think about the risks that using AI poses and how we should think about these. And we can't outsource policymaking to AI either. We need the likes of Kwame Opong, Head of Fintech and Innovation at the Bank of Ghana, to think about what policymakers and regulators should do in light of all of the above. So AI can't tell us what they can, and so I'm glad we have them here. Well, maybe AI could, but it would just be repackaging what they say and giving it back to us. So actually, I'm delighted we have this wonderful panel here to tell it to us in person. And so with that, Arisha from CGAP, please take it away. Over to you. Tell us what you're seeing, the opportunities and concerns you have. Thank you.
Thanks a lot for the introduction, Rory. And I will switch to slides which haven't been made by ChatGPT. I just wanted to make sure you can see my screen. I hope it's working. Yeah, should be. All right, so I'll quickly introduce myself. My name is Arisha Salman. I'm a financial sector specialist.
It's not quite showing yet.
Oh, it's not showing?
No, try again.
Let's try it again.
Oh, there we go. Yep, good.
Okay, good. Sure. So, yeah, my name is Arisha. I am a financial sector specialist at CGAP, which is a partnership of over 30 donors housed at the World Bank. Our mandate is to advance financial inclusion through applied research. And I specifically focus on the use of data in inclusive finance. And that's what I will be talking about over the next about 6 to 7 minutes. Now at CGAP, we see data as a key enabler of financial inclusion because there is emerging evidence that there are data trails generated by poor people that can be harnessed for financial services that expand people's economic opportunities and make them more resilient. However, while there is great interest amongst financial services providers in leveraging these data trails and increased attention from policymakers, there are multiple challenges to overcome for impact to reach lower and traditionally excluded groups. What we've learned so far through our work on data, working with both financial services providers, but also regulatory authorities and policymakers, and there are a few things. It's a laundry list, but there are very interesting insights, and I will highlight the ones on the use of AI specifically. Now, we've seen that data has grown exponentially and will continue to grow. And while data about low-income people is lagging, some digital data trails exist for the majority. And I'll just show you what the market size we've projected for those digital data trails. Alternative data, which could be MSE transaction data or data perhaps generated through platform workers' activities, can be effectively used to offer credit to those excluded. And we've got evidence that the predictive bar is comparable to traditional credit scores. And we've done that with a few providers. We will be publishing those findings on how we believe that alternative data is comparable. Now, what we are seeing emerging, however, is while there are important applications of data analytics, there's very limited use of AI at the moment. And ChatGPT did quote some use cases, But we don't really see that happening in the markets we work in, because providers that work on low-income segments lack the skills, capacity, technical staff to use AI. On gender disaggregated data, we see that under certain conditions, gender disaggregated data analysis can be used to increase credit or improve the conditions for women without increasing provider risk. While most data-driven products currently revolve around credit, there is an opportunity to enable a more diverse set of financial services like insurance and investments. And finally, market sharing arrangements like open banking, open finance are emerging, and we see a lot of promise in these. However, implementation is challenging and lengthy. Coming specifically to what we see as the market size, we see that there's an increased availability of data trails that are expanding even further the frontier of financial services. So if you look on the right, we have the total adult population of low and middle income countries, which is about 4.5 million. And we've estimated that about 1.8 billion poor people in these countries all have access to a phone, and amongst those, over 1 billion use the internet, which essentially means that over 1 billion poor people are generating a pretty rich data trail. And amongst them, or there's about 600 million who do have access to phones, but not the internet, but they are generating some sort of trails through feature phones, which are more simple phones. And in that entire universe, about 1.2 billion people own a phone and have access to financial services, but there are still 600 million that do not have access to financial services. So overall, we see a huge market opportunity for those who are generating digital data to be served by financial services. We see that we projected that by 2025, over 2 billion people will have access to phones, and these are poor people. And that number will continue to grow over the decades or over the years. Now, from a provider perspective, we've identified some relevant use cases of data. Again, this is more the use of data and data analytics, not really artificial intelligence. And some of these are for consumer lending, for MSE lending using transactional data. We see the data that's generated on large platforms is pretty valuable for delivering financial services. We've seen the use of psychometric data for credit scoring. Again, the jury is out on how effective that is, but it is being used. And finally, we do see the value of data-driven insurance. And to conclude, what we project as the next frontier is actually not, we're not really betting on AI, but more on open finance, which is a multilateral data sharing scheme where multiple parties are able to share data. So these are public sector or regulatory framework driven. And customer data can be shared by certain financial sector players who are data holders with other financial sector players. So a big bank could potentially provide the data of its customers to a small fintech, which actually helps open up more opportunities for financial services. And sharing of customer data is strictly upon customer consent. And the main applications we see of this, and why we think it's going to be pretty revolutionary, is because it helps to reach those who are underserved, who don't really have traditional credit bureau scores, but are generating some form of data trails. And it also helps those who have access to, say, credit bureau scores, who have access to financial services, but the access is a very surface level. So it helps enhance the breadth, but also potentially the depth of financial services. So I'll conclude here, and we can hear from the rest of our panelists. Thanks.
Thank you so much, Arisha, for setting out particularly the opportunity you're seeing there. An opportunity you're saying is as yet not really being fully exploited. Let's turn now to one of the firms that is really leading the way in seeking to exploit this opportunity, exploit in the good sense, I would say. Isaac from Safaricom, how about you give us a feeling, a sense of what you guys are seeing and what you're up to? Thank you. Over to you.
Yeah, thank you so much. I think Arisha has really set a very good background for what I need to say. At Safaricom, it's good to emphasize that our mission has been to transform lives. And this to paint the context, this is about 35 million Kenyan citizens who have connection to the mobile network, and over 30 million customers who have access to mobile money. And this includes financial services, key being what we can call as virtual banking, but also credit, access to credit, which is significant in our growing market. So just as a bit of background, Safaricom has been existing for over 20 years now, with the mobile money product launching in 2007. So we just actually, yesterday is when we were celebrating our 16th birthday. We were launched in 2007 on 6th of March. So it's been a journey for us. And one of the key things we have done, and it's mainly leveraging the use of data, is we figured their customers, a lot of our customers back then, when Kenya had 26% financial inclusivity, to the current situation with over 83% financially included citizens. And what that has been actually is more of partnerships. So we've really had to form partnerships that are leveraging data. I've had Aisha talk about alternative data. And for us, these are customers who didn't have any banking trails. So these are customers who would traditionally have been excluded from many financial institutions. And we formed partnerships with banks who initially were seeing, mobile money as a key competitor, but over time they've picked and seen that we're actually a distribution partner. So using data has been quite significant. A lot of customers who were not banked were then carrying out their financial transactions on their mobile phones, and for us using M-Pesa, which has been quite significant. So these customers needed to be fair, needed to be included, needed to have access to the financial services, and critical for business people, including women, was the access to credit. So in 2012, we had a partnership with a commercial bank, which is Commercial Bank of Africa, and we created a product called M-Shwari. And M-Shwari just means, it's M for mobile, and Shwari just means good. So it was mobile for good, if you put it that way. The product that came out there of that was demystifying access to credit. So while banks were, trampling down on customers who didn't have solid banking foundations, M-Shwari came and started giving credit as low as $1. And how that was done, using the GSM and mobile money data, scoring customers on the fly, and then growing.
Jump in. Are you meant to be sharing your screen?
No,
okay.
I don't have a presentation, so I'm just speaking through it.
Apologies.
Yeah, so I was talking about M-Shwari and the fact that M-Shwari just came in and started offering credit. And how that works is we are using the existing mobile money data, GSM behavior, and using that to the leverage of the customer. So while other people would see that as non-traditional banking kind of data, we then turned it around and started using that to score customers and give access to credit. We saw women who would come in the morning, take credit at 5 a.m., buy wares for the market, do their businesses. And at the end of the day, they're able to pay that credit and have a markup, which then sustains them for the following day. So over time, then we formed other partnerships. We added another bank in 2015 to offer similar product. And the reasoning was we need to have more people accessing credit. Of course, banks will look at what is the opportunity versus what is the chances of losing funds. So they'll scale down a bit on the commercial viability or the figures that are put up. And with adding more partners, we saw that being more democratized and more people accessing that credit. Then in 2019, we introduced what is an overdraft on the mobile phone, which is what we call Fuliza. It's now become an English word in Kenya. Fuliza just means if I don't have money, I can continue transacting using the traditional overdraft kind of concept. We saw in the first 1 month over 1 million customers get on board. And again, the power of that was real-time scoring of customers, using the mobile footprint that the customers have created over time, and giving them access to instant credit, which is contextual. So instead of taking money out, then I go and withdraw or I go and misuse it, you would use that credit to complete a business transaction or to complete a purchase that you're making using M-Pesa. In the most recent partnership, so we are now working with the government of Kenya, and the president in the campaign period promised to have a fund for what we call hustlers in Kenya. And hustlers just means that person who is a micro SME trying to form a business. That's a lady in the market who is buying wares and selling. The small businesses, the bottom of the pyramid. How do we allow them to have access to credit? So the president created a fund called Hustler Fund. And of course, a lot of it then is moving over the M-Pesa rails. So that was launched in 2022, November. And within 1 month, it had actually surpassed the 10 million customers who had subscribed to the product, and they had accessed as low as $5. And we've started hearing of transformational stories coming out of that. So for us, all this is anchored in our mission to transform lives. We are working using our data. We are building more on the AI and the big data capabilities. We want to also use this to improve the customer experience, extend this to the SMEs on top of the consumers. So very soon we'll be launching a product for SMEs, and it will be a lending product again based on data. And for us, this is what then layers back to our mission of transforming lives. So I can pause there, and we can handle the questions at the end.
Thank you very much, Isaac, for that really rapid overview of the huge amount of innovative work Safaricom is doing. Let me turn to James Claude from Global Voice Group, who I think can help us understand how data can be used beyond the individual commercial financial service opportunities that we just heard about, and into public goods of regulation and so on. Please, James, over to you.
Thank you. Can you hear me and can you see my screen?
Yes, and yes.
Excellent. So just anything here. Okay, perfect. So big data technologies for an inclusive financial ecosystem. As Group, we come from we look at things from the standpoint of regulatory bodies, and our focus has been developing countries, especially in Africa, and how big data can be used as the underlying technologies for AI, for predictive analysis, and so on. We've been working in Africa for the past 25 years, where our solutions has helped many government agencies, such as telecom regulators, central banks, to have a clear oversight on their respective sectors. So following up on what are we seeing in Africa, we see clearly that digital payments and mobile money are clear drivers for socio-economic development. We, based on information that are available everywhere, there is a clear, by 2025, we believe there will be a 20% growth in revenue when it comes to e-payments, which is, we're talking about $40 billion US. And in 2021, there has been 39% growth in mobile money transactions in Africa. So it's more than from 495 billion to 701 billion. So Africa today accounts for more than 70% of all the world's 1 trillion mobile money transactions. So we see a clear movement and innovation in Zimbabwe, Kenya, Tanzania, especially East Africa, but also on the West Africa side, like Nigeria, that has opened the market now for mobile money. As we know it in East Africa is starting to really boom, and Ghana as well. So besides, despite all of those encouraging trends, there are also a few challenges that we are seeing. We consider them to be roadblocks that can prevent a sustainable and financially inclusive ecosystem. The good news is there are many agencies, there are many initiatives from regional stakeholders such as Smart Africa and others trying to see and work with regulators and service providers how to overcome those obstacles. One of them we can mention, just to name a few, is the lack of infrastructure that can provide smooth access to financial services. But the good news is when we compare to where we came from 20 years, 10 years ago, and there have been significant progress in these aspects. If you take a country like Ghana, 4/5 of their GDP are transacting through mobile money. So this is a major achievement. There is a clear lack of digital financial policy and regulation, lack of policy harmonization. That's something we've been working with different regulators, how you can put in place adaptive regulation, because today, as a regulators, you can have the tools, you can have the means to access the information, and then this way you don't become an obstacle for the development of the sector, especially all the innovative aspects that are related to the development of the financial ecosystem. Also, obstacles is the increasing fraud in digital transactions, because the hackers, the fraudsters, they are there. Something which is very common in Africa is when they use SIM card swap. For example, someone goes to one of the MNOs and tell them, listen, I've lost my SIM cards. I'd like to. But what they are doing is stealing identities of someone, where they can get access to the funds the person has in his wallet and start transacting. So there are a lot of frauds in that aspect. That's why one of the key solutions that we are working in many countries to help them is to how you can reinforce your KYC as service providers. What is the role of the regulators to make sure that they put in place the right rules and regulation to make sure that the end citizens, the end users, and the citizens are fully protected? And of course, there have been a lot of innovation, but we believe there are rooms for improvement. And the last one to mention as the roadblocks could be the lack of digital literacy. Okay, so although the mobile phone penetration has been growing, we believe there's still room for trained professionals to develop effective solutions that take into account the level of literacy of the users interacting in the whole ecosystem. So other aspects that I'd like to cover is when we engage regulatory bodies, one of the sources of concern they have is the lack of data, and that's what our solutions are around. How, as a government, while taking into account the data privacy, which is very important, you can get all the information, all those data, in order to fight against two things. First of all, is the revenue leakage, to fight crimes or frauds that are happening in the ecosystem, and also this way you can, as a government, you can see the impact of the different rules and regulations that you are setting up. So, in other words, we believe big data technologies as the underlying technology for AI can be an enabler to improve compliance in the whole ecosystem, while taking into account, as I mentioned earlier, the laws and data privacy. So you can seal the potential leakages, at the same time using predictive analysis, flag suspicious transactions. So in other words, it can be really the proper use of big data can help in effective monitoring, and at the same time help in the innovative financing for development, which I'd like to cover in this slide, where we also believe if most big part of the economy in those countries are informal, but they are somehow embracing the use of digital payments, of mobile money, it's also an opportunity for revenue authorities to increase their tax to GDP ratio, because one of the issues Africa has been facing is the lack of local domestic revenue mobilization, because of a big part of the economy has been operating informal using cash. But now, as they are coming into the financial sector, there are ways for merchants to start paying their taxes, for governments to start applying innovative type of financing where they can apply micro-levies on transactions. in order to boost their tax study revenue. And so, in order, just to conclude, I'd like to mention a few aspects where big data and AI can really be very helpful for regulatory bodies. Full compliance in key economic sectors, strategic support to strengthen policies and regulation, prevention of revenue leakage with the right infrastructure, of course, and can be, as I mentioned earlier, like a tool for additional revenue mobilization. So a data-driven revolution can increase really financial inclusion, but this is from the perspective of regulatory bodies and telecom regulators, revenue authorities, central banks, and that in this sense, all the participants in the whole ecosystem can be protected and can benefit everyone. Thank you.
Thank you very much, James, again for a comprehensive but fast high-level overview there. Let's turn to Alex Rizzi from the Center for Financial Inclusion, who I hope will tell us a bit about the research that they've been doing on the use of big data and AI and data trails, especially domestic migrants. So please, Alex, over to you.
Thanks so much, Rory. It's a pleasure to be here today, and glad that AI hasn't replaced us yet. And it's really great to hear all the different vantage points that the panelists bring on this topic. So just briefly, a bit about the Center for Financial Inclusion. We're a think tank that's housed at Axion International, which is a 60-year-old inclusive finance nonprofit. And at the Center for Financial Inclusion, we focus on research and advocacy to advance inclusive financial systems. 4 of our big thematic priorities are consumer protection, responsible data practices, which is the work stream that I lead, climate change, resilience and financial inclusion, and gender and financial inclusion. We're also a convener for industry events and act as a platform, such as the Responsible Finance Forum and Financial Inclusion Week. So on this topic, first, I want to acknowledge the incredible potential of these tools and the different use cases that Arisha, Isaac, James, Rory, and ChatGPT spoke about, and their ability to affect change in the hands of providers, consumers, and governments. The kind of triad of increases in alternative consumer data, advances in analytical capacities, as well as data sharing infrastructure like open banking is just incredibly powerful. I also want to draw attention to the reality that AI and algorithms are making hugely consequential decisions for low-income consumers. Decisions like who gets access to credit and at what price, decisions on who is flagged as a fraudster, decisions like who is deemed eligible for a cash transfer program during COVID when everything was locked down. And these high stakes consequential decisions are more complex than ever and are more difficult to understand as algorithms, AI are making them rather than frontline staff. And at CFI, we've prioritized understanding some of the risks around these tools, specifically the risks of exclusion or harmful bias, misunderstanding individuals or groups of individuals' economic potential or creditworthiness, which could run against the inclusive finance goals of many of these interventions. Of course, like the use of data, harmful bias is not new in financial services, but algorithms and AI have the potential to perpetuate harm at a much greater scale, kind of orders of magnitude greater than more human-driven systems or a biased loan officer, for instance. And so in some of our work on this, excuse me, we started off publishing a framing paper to help us understand the ways that harmful bias, but also mitigation strategies could be deployed throughout the life of algorithm development system. And so we used 3 buckets. One was inputs, which refer to the data training, the inputs, the ground signals that inform the development of an AI and algorithmic system. And so you could imagine something going awry at this stage. Sorry, I should have had a cough drop. If an algorithm, for instance, that's evaluating creditworthiness is using historical income data, and the gender gap in salaries might lead to unfair outcomes for female applicants. So that's a bucket of inputs. Then there's the bucket of code, which is the model and any technical agents that help, they're part of the model and the code itself. And issues that could crop up at this stage could be mismatches in what the data science team is optimizing the algorithm for, or unintentional proxies or correlations with sensitive characteristics that go into the model, such as the well-known correlation of geography often being as understood as a proxy for race in many markets. And then there's the bucket of context, which is sort of the business processes, the organization, the staff that are involved in actually deploying an algorithm. So in this area, a lack of representativeness among personnel who design and operate and govern models could increase the likelihood of problems related to harmful bias. And so after this framing paper, which I think is being shared on the platform of with participants, we wanted to delve a bit more into the inputs bucket and understand how data trails of already marginalized groups might intersect with AI and algorithmic decision making. And last year, CFI conducted research and interviews in India to understand how this could play out for one demographic, the more than 50 million domestic migrants. While domestic migrants have contributed hugely in industries in India, like construction and hospitality, commercial agriculture, they've faced challenges historically in accessing formal financial services. And we wanted to understand, with increasing reliance on alternative data and AI to make decisions in areas like digital lending, what are some of the opportunities and risks for them? And through our interviews, we learned that in the recent boom of digital lending in India, most digital lenders are focused on serving urban, young, formally employed consumers. And this makes sense. They have predictable income streams. They create large volumes of data that could be analyzed to determine creditworthiness. And when you start to think about migrants and their digital data trails, they don't easily fit these lending models that are built for this different demographic. In general, of course, migrants might have fainter data trails due to lower levels of digital activity, so they might not show up in data sets, but also the way that they show up in data sets might be complex for digital lenders to understand. Migrants' mobility could pose several challenges. Some migrants change phones and phone numbers between their destinations and home base, which could complicate verification of transactions or lead to KYC issues. We also heard from some of our conversations that a mismatch, for instance, between the location where a potential borrower applies for a loan and the location where the phone SIM card is registered could cause the applicant to be rejected. And this makes sense from an assumption, perhaps on the lender's side, that geographic mismatches might mean that customer could be harder to serve reliably, but it could unintentionally screen out viable borrowers who are on the move, like domestic migrants. And when it comes to assessing cash flows to determine repayment capacity, migrants' digital data trails are more complex. Even if a migrant has an established and somewhat stable income from multiple years of employment in the same spot, going back and forth, their payment patterns might not be well understood or digitized or organized in a way that models could understand. Some contractors provide advance payments to migrants while others pay weekly or monthly, and some cover living expenses for migrants but deduct the costs from their salaries. And in addition, migrants' digital data trails might show kind of confusing varied consumption patterns across their two locations. For instance, in the place where they're working, they might be spending money on accommodations and food, but back at their home base, they're spending on household expenses and children's education. And all of these variations in earning and spending may not fit within a lender's model of what makes a viable borrower. And I just want to highlight one organization that we came across that was putting in time to nuance this for domestic migrants, a group called India Migration Now, and they were working to understand the nuances of the data trails that domestic migrants create and help to build a scoring model for that. And their model leveraged kind of bespoke, if you will, data inputs like the frequency of travel, the place of origin, the destination, frequency of remittance transfer, the length of stay at the location where they work, and mobile top-ups. But this kind of focus or this kind of nuance that India Migration Now is doing requires commitment, research, time, and resources, which might be less attractive to other digital lenders when there are already lower hanging fruit in terms of potential customers and their data trails. So this is just one example. I just wanted to raise attention around that. I think it's important as we build and deploy these tools that we think about the ways data inputs and algorithms intersect with the digital lives of those at the margin. So we can ensure that these tools are employed, the tools that are employed can really meet the inclusive finance goals and aspirations that I think we all have for them. So.
Thank you very much, Alex. And I want to come back to you with some questions in a moment. But first, we want to hear, having heard all that we have now from different perspectives, we have the policymaker in the room from the Bank of Ghana, which, as James mentioned earlier, is one of the leading countries. Kwame, perhaps you could give us really your big picture view from the policymaker's perspective. Over to you, please.
Thank you very much. And I hope you can see my screen.
Yep, we do. Thank you.
Okay. So I think from my perspective, perhaps what I'm going to try to share is more around the issue of what is really driving much of this. And I think if you really look at this whole picture, there's a clear effort going on, particularly in emerging economies, to pursue a digital economy efforts at a national level, of which central banks play a key role, in addition to other allied agencies and regulators that support that whole national effort to create the opportunity for private sector providers to extend services beyond the last mile and to underserved populations, as has been discussed. Now, in that effort, we have seen that a significant portion of it focuses on the financial sector. And so we're seeing areas being disrupted by fintech companies in partnership with banks and other entities, lending, payment aggregation, remittances, savings, acquiring, crowdfunding, etc. Now, what are the main drivers of most of these trends? And largely, it has been one, AI, which we're discussing. The second part being, we think machine learning also playing a key role. Business, analytics, big data analytics is a third and important leg of that whole discussion. And of course, the availability and increasingly reducing price points of some of these devices. So it's a combination of the price points going down, but also we see that increasingly the devices at the lower end of the scale are actually improving in their capacity and their capability, which is enabling more productivity and usage by digitally included people. And so what are the implications for central banks here, particularly as regulators or as financial sector regulators? It really comes down to what do we do? And in view of the fact that there are two dimensions to this whole issue. The first one has to do with the fact that the market is already evolving. This is here. This is not futuristic. This is already here. AI is here. Big data has been here for quite a long time. The issue is what is being done about it as part of our supervisory work of the sector, particularly as we see from all the previous conversations we have heard, the value that AI and big data can bring to several aspects of our policy objectives, whether it's improving lending, whether it's enhancing and addressing the issues of financial inclusion, or even if it's from a basic perspective of operationally enhancing the efficiency of the entities that we supervise. Then when you turn around to look internal as well, it has an implication on us as regulators. What do we do to make ourselves familiarized with these concepts, to be able to equip ourselves to understand these concepts and know how we can adequately be positioned to supervise its use, but also employ it internally to also derive similar benefits. whether it's operational efficiencies to improve our turnaround time to our stakeholders, whether it is from a basic oversight perspective and supervision perspective, so we know what's happening where and be able to pick up patterns that individual supervisors and supervision officers may not be able to identify. And these are things that really have to set us as regulators thinking as to how we proceed with this. So on the Bank of Ghana side, I'm going to give a few examples of how we have approached this. First, we embarked on implementing a customer complaints system called Akushika. This is really an AI-powered tool, which was initially intended to be able to support with automating our customer complaints mechanism. So think about it this way. When a customer comes to complain via email, walk-in, etc., it has to be processed, it has to be reviewed, and then sent to the respective functions within the bank that has responsibility for supervising the entity involved. Then there's a revert to follow up. And as you can imagine, these are processes that take a while and does not allow us to be responsive to the entities that we supervise. So automating that process helps us to be able to leverage AI and all the associated technology to be able to receive such information, process it quickly, expedite our response, and get an intervention quickly to ensure that we're enabling and engendering trust in the financial sector, particularly the emerging financial services space, the DFS space. And then as a next step to it, we also further enhanced that tool with basically being able to respond to the usual and frequently asked questions that people may have, or perhaps be able to point them to where to get this information or that information. And by so doing, reducing potentially the information asymmetry that exists between the regulator and either the regulated entity or consumers who may need information relating to the sector or even their own rights as a consumer. Next, I'll highlight something that we recently did, which is the Supervisory Intelligence Platform. Now, this platform is really an in-house MIS type operating platform. It was developed in-house to basically be able to give us some visibility. So we're getting access to data and we're collecting this data, but what are we really doing with that data and how much more data do we collect? So in the past, I think it was standard that most regulators in our part of the world would collect a template of information. We moved a step away from that into taking data dumps within those same periods. Our goal is to be able to go fully automated, but these data dumps give us a lot more granular details to be able to analyze our reporting entities data by gender, by location. So this is also geospatial based to be able to identify trends and patterns that speak directly to our responsibility as regulators and supervisors of those sectors. And right now, we're actively using it for the mobile money sector, as well as the payment service provision space, so the emerging fintechs. So we can know who's doing what trends we need to look out for, what trends are emerging, and we can respond from a policy standpoint in a much more timely manner. So that's an example of how we're employing big data analytics. And we're hoping to continue to enhance that platform with a lot more capabilities and a lot more data sets. And perhaps finally, I'll touch on something that is even more bank-wide, and that is the implementation of an online regulatory analytics surveillance tool, a system we call ORAS. And this system is really a simple online portal to automate and simplify the information collection layer of our regulatory work between us and our regulated entities. And this tool also allows them not only to submit their online returns, but also allows us as regulators to get a good view of who our entities are, data around them, be able to organize the data a bit more effectively, and also be able to view reports published by each ORAS user. Now, what this means for us is whether it's a previous user or a separate department that may have a comment or report on an entity within a certain space, that available set of information becomes a bit more actionable and ready for every authorized user who has a responsibility for supervising the space. And that level of simplification of information access and coordination enhances our ultimate work output. So this is just an example that I wanted to share with regards to what the responsibilities are for regulators and perhaps some of the ways we can start addressing it. respectfully recognizing the fact that there will always be distinctions in capacity between regulators in more developed markets and regulators in developing markets. Realities in terms of capacity, human resources, technology capacity, technology platform stack and readiness, etc. But I think there's a journey, and I'll talk a bit more about that in the course of this discussion. Thank you very much.
And thank you very much, Kwame. Very interesting hearing the innovative ways that you are using the data yourselves for regulatory purposes. Well, let's just take a little bit to get some more input from you all. Maybe going back to Arisha from CGAP. You mentioned that customer data there's a lot of potential uses for it in financial services, and you talked about the base case of lending. You have talked then about investment and insurance as potential use cases. Could you just say a bit more about the kind of applications of customer data that you're seeing that in your data project, some examples of providers that are using it, and any challenges that you're seeing?
Sure. Thanks, Rory. And it was great to hear from the rest of the panelists. And one of the points from Safaricom resonated well from Kwame. So I will maybe start off with a provider we're working with called Jumo, which is a mobile financial services provider based in Africa. And what Jumo does is it works with mobile network operators on the one hand, but it also works with financial services providers. And it leverages telecom data for credit scoring. Specific data points include airtime top-ups and P2P transactions. And what it does using this data is develops an initial credit score. Over 85% of its customers have had access or have no credit history. So they're very thin file. And it delivers this through USSD channels. So customers don't need access to the internet or access to smartphones. And over a period of time, the model works on small term and short-term loans. It helps users develop credit histories that then help them graduate to more sophisticated financial products. And it does work with regulated financial services providers, so who actually deliver the product through MNOs, or who design or underwrite the product through MNOs. And we see that the overall market share and the reach of Jumo is extensive. So that's the use of data, of telecom data. And we've also done a study in parallel, which shows that at least in Africa, over 90% of phone users do have airtime top-up data, which could be pretty transformative. Another provider we've worked with is Fundfina in India. And Fundfina is a fintech which works with small businesses. And these businesses range from agent networks or individuals who serve as agents, but also retail store owners. And instead of using traditional credit scores, it uses transaction data and stock inventory data to underwrite credit. And we've developed models. We'll be publishing this research pretty soon, which shows that the data or the credit score developed by Fundfina is very comparable to that of traditional credit bureaus. And finally, I'll give an example which is not for credit. It's called Mercado Pago. It's a huge fintech which is a subsidiary of Mercado Libre, which is an e-commerce firm based in Latin America. It's the biggest in Latin America, and they're using customer data as well as product data on the Mercado Libre platform to provide extended warranties, which are a form of insurance. And the extended warranties are for Mercado Libre customers. We've seen that the data points that they're using on customer behavior, as well as the data points on the specific products that are sold through Mercado Libre, including brand reputation, volume of sales, helps determine the price of the product, of the extended warranties product. So these are some of the applications, but we do have a number of case studies, another one of them being the use of platform data by this company or the fintech called Karma Life in India. So I'll stop there. And just to highlight the challenges, I missed highlighting those. Some of the important ones are that providers find it pretty challenging to estimate the potential value of external data sets, which makes it difficult for them to extract value from them. And a lot of these models are based on data sharing and partnerships. And there are a lot of regulatory and other partnership-based challenges that they face in being able to share this data. So I'll pause here and
well, let me pick that up, because and I'm going to want to get some thoughts also from Isaac from Safaricom and maybe from James from CVG Group on this. So you're mentioning their partnerships, and in fact, Isaac said a lot about partnerships. He explained how important partnerships have been in building out business models, starting with Commercial Bank of Africa for Mshwari, and clearly the commercial incentive that drives these partnerships, that brings together those who have the data, in that case the telcos, with those who know how to make credit kind of analytics using that data, the bank. There's clearly a commercial opportunity in there. You mentioned in your presentation earlier, I think, also more open finance themes, and that's where you're no longer looking at the commercial model that's market driven, that's initiated by those who see the opportunity and run after it, but rather where regulatory intervention comes in and says, okay, you've got this data, we're going to view it a bit like a public good, you've got to make it accessible to those who might want to use it. And so we, the government, the regulator, is going to require you to do that. And I just wondered if you had any thoughts about whether that helps, or, and I'm going to ask this question also to Isaac, whether it might impede in any way some of the commercial initiatives around that. Could you just say a word or two about open finance data sharing, please?
Sure, and you've covered most of it. So that's exactly what I was going to highlight through this on data sharing. So what data sharing does is, by bringing in a regulator, and we'd love to hear from Isaac, or bringing in a regulatory framework, it facilitates data sharing. So every actor who participates in an open data sharing regime like open finance is obligated to share their data, and there are enormous opportunities this could open up, the most important being in credit scoring. So for instance, Jumo now does not have to enter into an agreement with say Safaricom, or a written agreement, but they can share data based on customer consent if the customers agree to, in a world where telco and fintechs can share data, which opens up enormous opportunities. It increases, it significantly reduces the time it takes to take markets to product, take products to market, but also increases the number of individuals who can be served through these products. And I won't highlight too many use cases, but some of the other ones that we are seeing where open finance is live, which is in Brazil, and one important one that we thought was very inclusive was on personal finance management, but not advanced personal finance management, but on alerts and overdrafts on customer accounts. Because now a financial service entity in Brazil can have a good view of all the accounts that a customer holds. And therefore, if a person is running an overdraft, they could potentially alert them. And it's gone live with one bank, which is New Bank, which is a pretty forward-looking and transformative player. And we are seeing other use cases, but it'll be very interesting to hear from Isaac and the others on this.
Yeah, Isaac, if you're able to pick up a little on this theme, what the benefits of open finance type rules could be, and whether they might also rather impede commercial initiatives if you feel like the opportunity is just open to anyone? Well, are you so likely to run after it as quickly? Do you have any thoughts on that?
Yeah, thank you so much for the opportunity. So I think from where we started, this is way back in 2012. I don't think open finance has become as popular as it is now. But what we actually went to is a data sharing agreement between us and the bank. So we would share specific parameters that were of importance as far as scoring the customer is concerned. The way I see it is, as a customer who is really struggling with financial inclusion and access to credit, that data does not help me if it's not being used to my advantage. And so we saw a lot of customers opting in for us to share their data with the bank, so that then the bank can score them, because we were not doing the financing ourselves, and we were not willing to do the financing as a telco. So working with the partners, how much information are you giving them to lower their risk of credit and to make sure that they're lending to the right person? So we've seen that open up a lot of opportunities. With now data protection laws having come on board, it's just a question of balance. How are you making sure that the person you're sharing data with is using that data specifically for the intended purpose, and they don't start, spamming the customers, making a lot of offers that are not tied to this product, or any form of abuse, and making sure that that data is also very well protected, because now you are also almost delegating the responsibility of that data storage to another that party. The beauty of it is it's a financial service, it's a bank, commercial bank. So as far as the regulation is concerned, we are both regulated by the Central Bank of Kenya. So they also held to as high standards as Safaricom as an entity. And so that risk is quite well mitigated. I still see that as a big opportunity as we get into next financial services as a business, insurance, wealth management kind of products. We are then expected to share the relevant information, probably not the same data we share with the credit companies, but information that will help those partners make the right decisions for the benefit of the customer.
Thank you. And Kenya recently introduced its new Data Protection Act. Has that changed significantly the way that you're managing data within Safaricom, or your data sharing arrangements with partners like Commercial Bank of Africa and others?
So I think it just created the sensitivity around what information you need to share. You make sure that you share minimum possible information for the benefit of the product. Initially, I don't think we were as sensitive to how much information we were sharing. What I'm seeing as a bigger impact is around the payment ecosystem more than the credit providers. Because traditionally, we would pass the mobile number of the customer who is paying to us for market. That is coming to bigger scrutiny now. Some of the people who are getting that information spamming customers heavily, and behaving like customer by paying using mobile money. The customer has not opted into your services, into your promotional messages. So it's just that balance. But for the credit products, it's worked very well. I think I would say we were almost data minimization compliant from day one. As far as payment is concerned, we are then looking at, are we passing more than the necessary information for a payment transaction to be completed? For credit, I think it was necessary because you're also disbursing by that money on the mobile number, and all the relevant information being shared is what any bank would ask for as far as credit is concerned.
Thank you. Thank you. Let's build on this theme of how data is being used and access to it. James, I wanted to bring you in on this. We've talked about data is made available to partners for commercial initiatives. Arisha raised the theme of making data more widely available on an open finance model. You talked about using data to enable regulatory authorities to regulate better, and Kwame also was talking about doing the same. Can you give us a little more flesh on what you told us about how you, without giving away all your core business secrets, but how you are using data? Give us some examples of the technologies you've implemented to improve market oversight and financial by regulators.
Sure, thank you. As a big part of the economy in developing countries, especially in Africa, are embracing the use of technology, the use of mobile money, which is an African creation. we saw the opportunity to work with the central banks and the telecom regulators, which oversee the infrastructure on which mobile money is deployed, to collect information so you can monitor compliance. One example, if you look at mobile money, it's not an expansion of the monetary supply. It's, I mean, for every e-money circulating within the ecosystem, it should be backed up by real money that deposited in the central bank. So now, the way it used to happen before in many countries like Uganda, Rwanda, before we implemented our solutions, the service provider used to come and report, listen, this is $1 million we have in a bank account. This is the e-money that we have transacted over a period of a week. So with our system, we're able to collect those data in real time. So at any given time, they can always compare, this is what we have in the ecosystem as e-money flowing, because otherwise you might create a systemic risk to the country economy by expanding too much your money supply. So those are things that we help the policymakers to monitor using big data technologies. Other aspects also to take into account, by having those information in real time, we've been successful in many times to support central banks in finding read patterns that could be identified as fraudulent activities, because by having the data across different service providers, because as regulators, you have access to all the providers within your country. So you are able to cross information between different platforms, something that as Safaricom or as MTN, I might not be able to see the whole picture, but as a regulator, you are well positioned to have all of that information. Of course, there are certain things that we have to take into account when it comes to data privacy, by taking into account the laws in specific countries and what type of information could be accessed. And then we aggregate and anonymize certain information. This way, we can find, as Isaac said, the right balance between data privacy and the use of data. And so by working like that with those regulatory authorities, we are able to protect this financial ecosystem, which at the same time is by itself is furthering financial inclusion in most of the countries in Africa.
All right, thank you. Let me continue this theme by bringing in Kwame on it, because and Kwame, you might you have some thoughts on what James just said, or James, you might come back in on what Kwame says. Kwame, you talked about your supervisory. Let me make sure I heard it correctly. Intelligence platform, and I was interested particularly in where you get the data for that supervisory intelligence platform. How is it just reported data from financial service providers, or do you have access beyond that? And where are you getting it, and what kind of help are you calling on? Are you a client, for example, of James's Global Voice? Tell us a little bit about that.
Okay, well, thank you very much. So the supervisory intelligence platform currently gets data that is reported by the institutions. And I think the goal for every regulator in this journey should be to go from a passive receipt of template type information where they're submitting something to you, which always leaves room for errors and other issues, all the way to perhaps a machine-to-machine type reporting where you have direct access to the reporting portals and you can pull that up. There are several implementations where, as James described, you could actually have a third party actually create that access for you, because entities like Global Voice Group are also engaged in supporting not just central banks, as he mentioned, but communications authorities who are checking to make sure tax compliance is appropriate and all that. And therefore, there's some direct integration there, so they are able to share some of this reporting. We also have access, read-only access to some of the reporting portals of some of the large platforms in our market. So that addresses it. But for our supervisory intelligence platform, the current stage at which we are is actually submitted data from the entities, but this time in data dumps, and so gives us all the granular details that we need. But to the broader point about regulators now having to take this step, and this is where the need to have an internal capacity comes at play, because as you sit back and listen to this conversation, the good that credit digital credits is doing when you look at the prospect of open banking, which basically says, I'm a consumer, I own my data, I should be able to take it here to get, to vendor A or B or service provider C to get access to financial services, should I be restricted somehow? But we also recognize that through that process, you often find some unfortunate challenges, which includes things like discrimination against women, youth, even migrants, or perhaps where you live in the country. As it stands right now, I don't know if, I think most of the audience may be aware, some of these digital credits assessment algorithms can actually discriminate people by looking at their dexterity. It could actually, for instance, look at the quality of your sentence construction and reduce your credit score. Even more concerning is more significant issues such as if I have someone with bad credits on my contact list, by giving access to my contact list, it could impact my score. Now, this is a classic case of show me your friend and I'll show you your character, but in this case, your credit score. Is that actually something that is ethical? Should we be able to let that happen? But the question becomes, for you as a regulator, do you have the capacity to even understand, to be able to disaggregate some of these algorithms and understand what the intent of the algorithms are? So that's a fundamental question we need to be able to answer. And I think this is the inward part of it. But as we look at issues around data sharing, right? So not just, and I remember a couple of years ago, GSMA, I think for a while, has had a standard on how you extract data anonymized at the Terra. How are we accessing this information? What is the limitation on how much information should be extracted and shared? And how much information is sufficient, right? Are you going on a fishing expedition because the customer is giving you access and their consent? And even to that point itself, right? Privacy issues, disclosure, and consent. Is the disclosure sufficient? Is the consent sufficient? And is it consent for one activity, or is it a perpetual consent? And what is the mechanism for ensuring that should the customer decide to restrict it, they're empowered with the tools to be able to restrict it? So those are the things. I think there are other aspects as well having to do with, we recognize the fact that if you have to address these things, you also have to look at the commercial value of the information being put on the table at the Terra. But from the regulatory standpoint, are we sufficiently equipped, or at least minimally equipped, to be able to assess these things and make a good judgment as part of our supervisory work in guiding how they proceed? And that's where each entity has to review its capacity and then make a determination as to how they proceed forward, whether by building the capacity internally or perhaps securing the services of third parties as well.
Let me just ask
you. If you allow me just to add on what Kwame said, one thing that we also realize in many countries is the collaboration between government institutions, such as central bank, revenue authorities, and telecom regulators. So, one of the key issues we are seeing is when they work in silos, sometimes they are requesting the same information to the service providers, and then they have different systems that don't necessarily interact with each other. So working together and bringing in at the early stage of the project, the Data Privacy Commission can be very helpful and useful to make sure that those projects are a success and can benefit the whole country.
Thank you. And I kind of wanted to turn your question, Kwame, back to you as well as to James. You asked, are we equipped? And I'm thinking of, bias questions, and I'll bring Alex in on this in a moment. If you look at a region, or if you look at a gender group, there may be less lending occurring to those, but to be able to identify whether that lower levels of lending is because there is actually objectively a weaker credit worthiness, or whether it is because of bias that's come in through the training data that, as Alex talked about earlier at length, particularly on the Indian migrant case. To be able to identify whether there is bias in there requires AI at an even higher level in a way than the AI that's originally used to run the credit analysis in the first place. And is that something that you're seeing other regulators in the financial sector being able to get equipped with, or are you looking to turn to outside firms that can supply that? And James, I think the question for you is that something that you're looking to be able to provide to authorities? So Kwame, first you.
Sure. No, I think fundamentally, the first step is, I think we're at a point where most regulators have come to terms with the fact that AI is here, AI is not going anywhere, particularly AI machine learning. The second part of it is also recognizing the fact that similar to many traditional institutions in the sector, we probably are sitting on a lot of information that is not organized in a way that is actionable. And so there's a need to jolt ourselves a bit before we get a nasty shock. So that awareness is there. That's the first layer. The second layer is, do you have the capacity to even understand what's happening? And I think that capacity issue is at two levels. I think at the senior level and the strategic level is recognizing the fact that similar to how certain skill sets were sought out and sought after during the previous decades in terms of recruitment and capacity, staff capacity planning, it is important that we start looking at some of these skill sets. Frankly, it goes through AI, machine learning, blockchain, and some of these areas, which whether you like or not, is encroaching into your space. So that's the first thing. But before that, I think most regulators are also coming to terms and should come to terms with the fact that we're not entirely helpless between now and the point where we have the capacity, whether you're recruiting new people to augment your capacity and also building capacity internally, either or, and a combination thereof. You can actually engage in very basic, and this is where judgment comes in. And you can engage as part of your licensing review processes, as part of your on-site and off-site inspections and the entities you deal with, engage in what is this and how does it work? What is the decision-making criteria? Because remember, AI is not human. AI can choose to discriminate against every Kwame whose name shows up in a database, right? Because perhaps previously, people with the name Kwame were bad borrowers. And so AI does not have that human element. And that's very important because we've seen this happen, right? We've seen this happen in the insurance industry where automated systems decide to make decisions on people's lives in the airline transport industry, for instance, which is just, besides the fact that perhaps there's a statistical correlation, it's just unacceptable for any any acceptable way of living. So it's a problem. So what you can actually do is engage to understand what is this and what does it do? That's the most basic. And I think as you continue to engage some of these service providers, being willing to understand the basics of it, it comes back, though it is a computer-generated outcome, that understanding of those correlations are there. And once they can be broken down into, you can now understand whether this is acceptable or this is not, or perhaps provide some guidance to it. And then finally, to that broader question of where do we go? Because as you're doing this, it's continued to evolve. The need to employ additional tools is very important. And some of these additional tools, unfortunately, may not even be ready yet, because obviously, soup tech tools in the soup tech space appears not to be as commercially interesting as building tools in the commercial space for consumers. And so sometimes I think we find ourselves as regulators with very limited options in terms of tools to either procure, to augment our work, in which case we have to either build in-house by bringing in experts or look at taking something that is out there on the market and sort of retrofitting it to fit our regulatory objectives and daily work. But this is something that also presents a divide between emerging markets and developed markets supervision. Because as you heard our colleague from CGAP mention, Arisha mentioned, this is good. Jumo is in our markets as well, right? And the work they're doing is so interesting. Within 1 year, in fact, 11 months in Ghana of operation, they had reached 1 million customers. That is a big deal for a $30 million population country. But how do we make sure it is also safe and organized in an orderly manner?
So on that, soup tech or reg tech, whichever we're calling it, James, you're the soup tech, reg tech provider on the call here. Before we turn to Alex, just for some closing points on from the outside of this, you're making these products for the regulator. Can you tell us what's about to burst into the scene that will support Kwame in their kind of work?
No, definitely. And the good thing about the way we work, our approach is to get the feedback, get the issues that the regulators or potential clients are facing, and based on that, we come up with the different solutions. Of course, I always say that we don't create our solutions or come up with new solutions. out of thin air. Those are sometimes the same issues that they face. We use the different technologies out there. We work with partners, technological partners from many places around the world to make sure that they take into account the African realities, which are where most of our clients are, so to make the proper adaptation so we can really serve them. Just to give you a quick example, I remember during COVID, the government of many countries wanted to provide support or some kind of help to the lowest income part of the population. And so when they came to us, including Ghana, since we have a data set of all the transaction patterns, we're able in a matter of a week to identify, listen, those are the way people transact through mobile money. Those are people who are transacting less than 3 or 4 times per month, and the amount that they are transacting. So we're able to come up with an algorithm to determine whether they are part of the bracket or where the government wanted to provide the assistance. So for us, that's the part of where we take the technologies from wherever they come from. We try to adapt them based on the challenges Kwame and other regulators are facing, so we can provide solutions that really take into account their realities.
Thank you. Well, thank you, James. That you're really tailoring things. Alex, I wondered just, especially the work that you've done in India, looking in detail at the Indian domestic migrant population. I think you said there were 30 million or 50 million domestic migrants, and you talked about India Migration Now, which was an initiative looking at trying to include those back into the opportunities we're talking about. But when it comes to the actual detection and correction of harmful bias, if it's present in inclusive finance, what would you say is the state of practice? Is it getting there and it's just a question of improving the algorithms, or is it really a huge gap and the providers are failing and the regulators don't have the products? And what's your view there?
I think somewhere in the middle. And the conversation that James and Kwame were having too was so relevant, I think, to the work that we're doing, in the sense that the need for, of course, for providers to do better, but also there are concerned stakeholders like regulators, policymakers, investors who care about the inclusivity and performance of these tools. And that's actually something we're working on with support from USAID to build a guide for impact investors to assess prospective and existing portfolio companies' AI practices. And I feel a lot of that resonates with what Kwame was saying about kind of the different levels that governments can intervene at with these tools, and also what kind of we're advising or hoping to build for impact investors who care about these tools but are not necessarily data scientists themselves. And this is something we're working with my colleague Luciana Alvarez and I, and are working on with Jonathan Fu and Mernal Mishra from the University of Zurich. And so in reviewing the state of practice, frankly, we haven't seen a lot in inclusive finance, a lot of applications, but there are a lot of approaches in other sectors that I think could be easily adopted. They're sort of the bucket of high-level frameworks and codes of conduct that are really more about awareness raising and kind of high-level principles on transparency and explainability, but they don't really go into the details of kind of technical approaches for mitigation and bias detection. Then there are sort of business process tools, which could include questions around governance, auditing, or even what I call kind of good data hygiene and data documentation, in terms of being transparent about the choices that your data science team has made on the sources of data, on the assumptions you've made, on the rationale for this tool and who you're trying to reach, so that if something goes awry later on, you have a good kind of documentation of how it was built. And then there are the really kind of the category of really specific data science, kind of machine learning techniques that usually follow a strategy of defining kind of a mathematical definition of fairness, and then kind of backing into that with specific data science or machine learning techniques. And I think you can draw from all of those different levels, and they can be useful even if you are not kind of a data scientist yourself, but you're interested in ensuring that these tools are being deployed responsibly. I haven't seen too many applications in our field. To be honest, Sonia Kelly at WWB is doing some interesting work. I know Sean Higgins at Northwestern has been doing some interesting work. And at the regulatory policy level, haven't seen too many high-profile cases where there are specific engagements with, around responsible AI and inclusive finance. I'd say Singapore might be the best example with Project Veritas, but would love to hear if others from the group have seen other examples. But I think what seemed missing to us were, applications of some of the existing tools in inclusive finance, but also tools for sort of this middle stakeholder, like impact investors and donors who want to ensure that what they're supporting is being done responsibly and ethically, but they're not going to necessarily be getting into the weeds of specific, data science techniques. And so that motivated in part this project that we're doing for impact investors. So those are a few thoughts on that.
Thank you so much. Well, let me just very quickly round up. We've really had a very rich and wide-ranging discussion there. Arisha from CGAP, I think, really outlined the challenge that's not yet really been met by private sector in terms of the volume of the numbers of people still who are producing data trails, even at the most minimal level, but data trails that actually can provide a sufficient data proxy to enable credit analysis really on a par with more traditional credit analysis, and I think really put a challenge to us to encourage this use of AI much more vigorously as people, especially as they move up the ladder of producing more data. She also brought up the theme of open finance, which generated a fairly interesting comments from herself, and then also from James. Isaac from Safaricom took us through the importance of partnerships at the commercial level by providers who have data and want to work with those who know how to analyze it, and those who want to put capital at risk in lending to or providing other financial services to those people, and gave us really a good snapshot of Safaricom's experience from Mshwari to Fulis and to the Hassa Fund that have been brought in. James Claude from Global Voice Group gave us a vision of how they are able to use data to particularly to support the policymakers, regulatory authorities in two ways. One, to improve their effectiveness in regulating and supervising and understanding the markets that they're dealing with. And then secondly, more on the revenue side, to formalize the informal sector so that there are records of financial transactions, and that therefore an ability to tax commercial behavior and raise funds for governments. We didn't get into that in more depth. That's something I would love to talk more about, because it's really a key one. Alex took us through the number of the risks, particularly some of the bias concerns that can arise. As she said, AI is making decisions about who gets credit, the price at which they get it, who's deemed a fraudster, who gets a COVID cash transfer. These are really important decisions being made. How do you make sure they're made well? And they look to data inputs and context and codes that are used, and had told us very interesting results of their study in India of the domestic migrants. And then lastly, Kwame from Bank of Ghana really gave us a deep view from the policymaker and supervisory authorities perspective of the opportunity of using AI, but some of the challenges that are still there. And I got to say, if the commercial players haven't yet quite figured out how to make the AI work optimally to reach everyone that they possibly could make some money for, it's going to be a real challenge for the regulatory authorities to have AI that can see even better what they should have done, and where they're resulting in discrimination through AI bias and so on. So I want to thank everyone so much for an excellent discussion. I understand that as I close off now, the audience is able to move to the neural networking space for a bit of chat. I believe that'll be open for a little bit. But for me, Macmillan Keck, thank you so much to everybody for participating. Goodbye.
Thank you very much.
Thank you very much.
Thank you.
Thank you.
Thank you for participating in today's AI for Good session. We hope you've learned something new, innovative, and engaging in today's event. We now encourage you to continue the conversation on the live video wall in the neural network. Here you can ask questions, like and comment, share links, complete the poll, connect with interesting profiles, or speak one-on-one using the chat and video function. We invite you to explore the lobby, try the smart matching quiz, visit the virtual exhibits, poster boards, the eShop, and build your personalized AI for Good program. Let's shape the future of AI for Good.
AI is a powerful tool.
This summit can help ensure that artificial intelligence charts a course that benefits humanity and bolsters our shared values.